Well, good morning, everybody. It's 10 a.m. It's a pleasure to have you here at LuxeSF for our very interesting program this morning on interest rates. We've gone to a 30-minute session today. Occasionally, we'll do these smaller meetings where we have an urgent issue that's come up and we think we can cover it in 30 minutes. We're more concerned with the urgency of the issue rather than extending the program out to a full hour. A couple of quick housekeeping items, as we always do. We have everybody muted on sound and video. Very occasionally, somebody manages to squeeze in. If you see yourself on the screen, please mute your video. The only two people who should be on screen are myself and our presenter today. This is one of those sessions where questions and answers will be very, very important. So feel free today to hit that Q&A button down the bottom there, the chat button, I should say, and you pop the question up, and we'll be very happy to to address it as we're talking to our presenter. And again, the question I always get: are we recording today's session? Yes, we are. We record all of our Zoom meetings, and by close of business today or very early tomorrow morning, you will get a link that we will send to you of today's recording. So that should cover that. So why today's program? Let me just read my obligatory paragraph here. After 2 years of robust and heated real estate activity, the perfect storm now approaches. Low inventories, historically high home sales prices, I should add. In San Francisco and Bay Area, I think it was, we saw a 20% year over year increase in home sale prices, 2021 versus 22, I should say, versus 21, I believe. Rising inflation and very aggressive Federal Reserve reaction have now been joined by interest rate hikes that may very quickly drive first-time home buyers and middle-class trader-uppers out of the affordability market. Today, we present this very important 30-minute session with our good friend, our seer, if you will, and our sage from HSBC, Jose Rasco, who's the Managing Director and Head of Investment Strategy at the bank. And he'll provide us with some incisive assessment of the current situation. And we can't expect him to be Nostradamus, but we are going to probe and see where he thinks the market is going to go. And again, we encourage questions and answer questions today through the chat button. Jose, welcome. It's a pleasure to have you again. Let's kick off and set the stage. What's the current situation with interest rates? And again, we learned today the GDP declined 1.4% versus expectation of a 1% gain. But sort of narrowing in on interest rates, what's the current climate?
Well, the current climate, first of all, thank you for having me, and welcome to all my friends over at LuxeSF. And I think if you look at the current climate, it's one where inflation, look, we've have constrained supply and we have excess demand. And that's the definition of inflation. So the Fed needs to get inflation under control, but keep an eye on the Cleveland Fed president. She's brilliant. And she was on TV like 2 weeks ago saying, we don't expect inflation to go from 8 to 2. We expect inflation to begin to slow. That's going to be sufficient for them because they know that a lot of this is just completely out of their control. Rates are going up. The market is priced in 9 interest rate hikes this year. That's 225, from here. At the bank, we think the Fed funds rate will go to 2% this year and roughly 3% next year. Probably 250 basis point hikes in here at least, and then a bunch of 25 basis point hikes after that. Now, keep in mind, one of the things that's been pushing this has been prices. In the 90s, from 91 to 2012, home prices, according to S.A. Schiller, rose at a compounded annual rate of 3%. In the last 3 years, from 2020 to now, prices are rising at 14% at an annualized basis, from 3 to 14. So that is part of the problem.
Zero in, and by the way, that 3 to 14% is national, correct?
No.
Yep. Zero in, if you will, for the interest rate increases. Let me just throw out, the traditional shibboleths. Ukraine war, any impact?
Huge, absolutely huge, in terms of different materials, and you would be surprised the number of industries that touches, and food, obviously, some other materials that are used for semiconductors and other forms of technology. So yes, major effect on global markets.
Supply chain.
Still a problem, and unfortunately, the lockdowns in China aren't helping. And so clearly, the constraints on supply are a problem. And in addition, keep in mind, a lot of companies have decided to rebuild inventories, but not to just-in-time levels. They want to take them up to just-in-case levels, and they want to move supply chain closer to home. So all that factored in means you're rebuilding facilities all over the place, which means slower supplies.
That will continue for how long, Jose?
A couple of years, yeah.
Okay. Political environment, let me put a couple of layers in there. Just Washington, D.C., midterm elections, the fact that Biden doesn't have a majority or a major majority in the Senate, which means he can't get stuff through. Where does politics come into this?
It's a major factor. Globally, geopolitics will play a role in terms of the war in Europe, what's going on in China, and then the midterms here. Clearly, Biden does not want to lose these midterm elections. He's a lame duck then for 2 years, and good luck getting the White House in 2024. So he does not want the Fed to raise rates aggressively, and they will try to pass some fiscal stimulus through to help buoy economic growth in time for the elections. Remember the Romney plan that was the bipartisan plan on infrastructure? From what I understand, checks start to go out in June or July. What a coincidence, about 3 to 6 months before the election. So everybody feels better. Politicians, they know the lag structures as well. So that should help growth, though.
So let me take that back to summary situation. Then, will Biden and the political environment in D.C. have an immediate or have a significant impact upon interest rates?
Yeah.
Can we tie the two together?
Yes, no question about it. Everybody was picking on Trump because he was trying to talk the Fed into lowering or raising rates. Every politician does it. And Biden will not be dissimilar from that. He may not do it in the press. He may not do it on Twitter, but they will have meetings where he will tell them. Now, remember, the Fed is not just trying to raise rates. They're also trying to reduce the size of the balance sheet. And every 500 billion they reduce, and they're doing about 100 a month. So every 5 months or so is like another 25 basis point hike in terms of tightening liquidity and making less money. The pool is getting smaller. So that is it. That is another issue.
Consumer debt, consumer spending. If I'm correct, consumer debt is reduced year to year, but consumer spending is going haywire. Yes.
Consumer spending is up and installment debt is rising. Rapid's credit card debt, auto debt, things like that, revolving credit, right? That's going up. But if you look at what they call the financial obligations ratio, it is at or near historic lows because so many people refinanced over the last 5 years. Your largest interest rate burden is usually your home, right? Obviously, as a household. And so therefore, if you refinance lower, that has reduced that debt burden for consumers substantially. So financial obligation ratios very low, which means the consumer is going to be more able to handle higher rates than most economists will assume.
So let's go to best projection, and I understand it's a projection only. Take us to 12/31, December 31 this year. How many increases, magnitude of increases, and what will be the impact of the increases?
Well, the HSBC view is to get to 2%, so it's substantial by the end of this year, and then another 50 to 75 basis points next year. So I think that's our official forecast. I think the downside risk to that is negative 1.4% in first quarter GDP. Second quarter, we'll see a bounce back, no question about it. That's just math. Even if we just flatline, we will be up, right? If for us to go down from there, that's a problem, right? And then the Fed can't raise rates at all. So I think that's the height of the experiment there, is to get us to 1.5%, 2%. And I think that's the most we can expect from the Fed. And the balance sheet stuff, that's gonna depend on the trajectory for growth. If growth goes positive in the second quarter, let's call it trend rate, like 2%, and then we see better expectations for the second half of the year, the Fed can move more aggressively. If not, they run the risk of a recession in the middle of an election year, which no Fed president wants.
We'll talk about that. Jose, convert the Fed interest rates to mortgage interest rates through December 31st again. Where will we be 12/31?
Well,
mortgage interest rates.
is almost 5%. Don't be shocked to see it go up another percent or so before year end. So I think, and if you look at we went back to 1981 and we looked at the cycles. There have been 10 cycles of mortgage rate increases, and the average increase is about 2%. And it takes about a year to get that through. We've already had 15 months of rising mortgage interest rates, and we're already up about 2.25. So we have surpassed historical averages. That said, if you look at mortgage rates at 4.8 or 5% nationally, that's down from the 1980s when it was 18%, in the 90s when it was 9%, and in the 2000s when it was 6%. So we're still down. If you look at that line, it still looks like a ski slope coming down, but there's no question we are breaking out to the upside. Now, remember the 10-year note, which is the basis, the risk-free rate is Fed funds, but that yield curve, it backed up to about 2.97 on the 10-year, okay? And now it has come down. That is a sign that people around the world are saying, that's a good yield, I will buy that. So they're buying that 10-year note. And as they do, it limits the upside pressure to mortgage rates. And the other thing to keep in mind is the inflation expectation. Short term, we're looking at 5 to 6 to 7% on inflation over the next year or two. Over the next 10 years, we're still looking at 2.5. So it's sort of like an inverted expectations curve on inflation. And what consumers and businesses are telling you is, I hate the word transitory because everybody's going to rip the Fed for that word, but transitory is a long-term transitory. It's going to happen for another year or so, and then we should normalize from those levels.
I remember the 80s and the 18% interest rates, and we got used to it.
Yep.
We just got used to it. Therefore, let's assume 6% mortgage rates by the end of the year. Let's assume that's the case. What impact does that have on the psyche of the home buyer, home seller?
Well, it's what we call in the world of economics, we call the steak to hamburger trade. And so, and you see it playing out in restaurants, you see it playing out in vacations people are taking and things like that. And you'll see it with home buying as well. If you look when rates rise, what does well? Which sectors of the markets do well? As rates are rising, it's home repairs, consumer discretionary, household appliances. So as rates are rising and you can't afford that new home, number one, you're going to trade down. If you're going to buy a $3 million home, you're going to buy an $800,000 home that you can afford. Number two, you're going to fix the home you have. So I think you will see that higher rates will affect the purchases, and we will trade down in terms of what we can have just based on affordability, right? Especially in that middle component of the market. The other thing to keep in mind is if I go to sell my home today because, hey, it's a great price, I have people stopping me in the supermarket asking me if I want to sell my home because inventories are so tight, right? But my rates are so low. If I were to go out and buy a house, even if I bought a house, at less value than the home I own, good luck getting a mortgage rate that's going to be anywhere near where I am. So affordability becomes a problem, not in terms of purchase price, but the service of that debt.
So stay with that, Jose. Let's assume again that it's 6% at the end of the year. That's the going mortgage rate. Who does it take out of the marketplace? Does it take out blue collar? Does it take out middle class? What demo is forced out because of that?
The middle to lower income quintiles, which may not be blue collar, by the way. It may be a lot of service industry people. It may be a lot of people in the tech space who are not in the more technical aspects of it, so they're not making the big bucks, right? And you're seeing a lot of facilities relocate from Silicon Valley, Silicon Alley to Florida, Texas, Colorado, and those folks may be hit hard. As a result, from what I'm hearing, multifamily demand is still very, very strong because they can't afford single family homes, so they move into facilities or homes that are more affordable, right? So it's the middle to lower income quintiles. On the higher end, you will definitely see a softening, a weakening of demand. But remember, especially in places like Silicon Valley and Manhattan, where you have limited space, right? The cycles tend to be a bit volatile, but they're more muted in the sense that there's only so much you can do, right? If you want to live in Silicon Valley, there's only so many you can pick from, right?
So the wealthy will continue to invest in real estate. That's not going to stop, correct?
Well, I think what you'll see is that marginal dollar that was coming from abroad to buy that great asset that they could buy at $1 million and sell at 3 million, that's gone. That's gone. Yeah, the investor, the flipper, right? In Miami, they call it the Brazilian flip. They used to buy homes and then flip them as soon as they could. So that for now, that game is ended, but that's a cyclical thing. That'll come back, right, as prices start to normalize. So I think you'll see that that will have an effect on the market on the margin, but that higher end buyer, if they're motivated, they'll still be there. The question is supply, right? How much of it is on the market and what can you get and where?
Jose, quick digression. I saw a case yesterday that said that the three top markets in the United States in terms of rising sales prices were Miami, Tampa, and I think Naples was the third. I know the three of them were in Florida. What the hell is happening?
What's happening is politics and economics. And so if you look, San Francisco, LA, New York, rising at 15 to 25%.
Correct.
That's great. If you look at Tampa, Austin, Jacksonville, Memphis, Nashville, Boulder, they're rising at 30% because they're in tax-free states. So what people are doing is they're moving where the jobs are. They're moving where there's no state income tax. New York, California, we both suffer from very progressive policies, right? Which is good on the social side, but it hits your pocketbook. And as a result, consumers are saying, hey, if I can work from home, I can work from home for my company in New York, but I can live in North Carolina where the cost of living is 40% lower. Sign me up. Or I can go to Jacksonville where the cost of living is 30% lower and I don't pay state tax. Sign me up. And that's what's happening. It's still happening.
So again, go back 12/31 of this year, let's assume 6%. The overall real estate market nationally will remain buoyant, yes?
By the end of the year, I think we make somewhat of a comeback, but I think we go through some tough times in the next couple of months for sure. Yeah. Once the Fed has priced in what they're doing, assuming we avoid recession, which we think we do, because underlying demand is very strong still. And we think China will open up and that'll help lift global demand. And the US consumer still is looking to spend. And the estimates I hear are about 2 trillion in excess savings still out there, mostly at the upper end of the income strata. So I think, yes, housing remains healthy and positive, but by year end, it's going to go through some tough times in the next 6 months. Yes.
And the reason for the tough times are, again,
higher rates, higher inflation, and affordability. Just, it's affecting that marginal buyer. But again, keep in mind that the financial obligations ratio, literally the line falls off a cliff. I'll send it to you. I should have sent it to you in advance. But if you look up financial obligations ratio, Google it, and you'll see it. And it falls off a cliff and it's very low. And so as consumers remain employed and wages continue to rise, as inflation slows, that will help the housing market. But first we have to adjust to these higher rates and that lack of inventory. And the higher rates affect sales as well as starts.
I saw a question just came in and I do want to address it. It says, has the market, i.e. mortgage rates, already priced in the next Fed rate hike?
Yeah, well, I mean, look, the short end of the curve has priced in 9. So the short end of that's why we had that inverted 210 curve, which is spurious analysis, right? The 210 curve inversion doesn't mean anything anymore. It doesn't count. And even when it does invert, you've got 2 years till you hit a recession. So don't lose sleep over that one. The important spread is 3 months to 10 years. And that takes about a year till recession. And that's still extremely wide. So we see no recession coming. Financial conditions have tightened, but they have not tightened that much. Remember, the Fed lowered rates to 0. In addition to lowering rates to 0, they expanded the liquidity pool by $4.5 trillion. So they didn't go to negative rates. They said, we're still at 0, but you have a lot more money to lend. And that meant you could take as much risk as you wanted. That's going to be curtailed, which means it's going to help slow things, but you're not coming from 0. You're coming from really like a negative 2 to 3%. So financial conditions will still be accommodative, even with these rate hikes in real terms.
Say we hear talk about bubbles, etc. Do we see? Is there a perception? Does this perception of the looming bubble impact the market, particularly the real estate market?
Yeah, look, there's a lot of news out there, and there's a lot of spurious analysis. I mean, how many people do you hear talking about recession? Right, tons. Yet if you look at the Bloomberg consensus estimate, it's like 40 or 50 economists. Not one of them has a negative number for GDP in the next 2 years. How do you get a recession if you have no negative growth? They're talking out of both sides of their mouths. Okay, so yes, housing is, I wouldn't call it a bubble, but it's in a period where prices grew excessively and it created an inflationary spiral. And as a result, and demand stayed strong throughout because demand is white hot, right? So I don't think that changes. And I think even if demand slows, I think it's still going to remain relatively healthy because people are relocating and all that. And I think that that marginal investment dollar is probably gone for a while. But higher rates will affect the market, but we don't think it bursts the bubble. It'll slow the housing market precipitously, no question, in the next couple of months. We think it starts to rebound by year end. Yeah.
Put a mortgage banker's hat on for a moment. Would you advise a 5-1 arm or a 7-1 arm?
Well, I mean, that's the interesting question, right? Rates have risen enough at the long end, right? Where if you can, I did that years ago when I bought my first house. We saw opportunity to get those teaser rates. And that's what's interesting about the market. Everybody assumes rates are up. We're all going to die. If rates are up, guess what's going to happen? Somebody's going to come out and go, Al, I'll give you the same house, but I'll give you a teaser rate for the first 7 years, 723, whatever. And you'll find people try to be more competitive. It's like the law, it's like people selling t-shirts, right? If we're both selling t-shirts at $15 a shirt and my inventory is backing up, I'm going to drop my prices. And that's what's going to happen. You're going to see people make housing more affordable in the next couple of months.
I've got a similar question here, rearms. Is the Fed overcorrecting this year, and do we think there could be a refi opportunity again in, say, 12 to 18 months?
Well, that's a fascinating question, right?
Isn't it?
Yeah. And what you see when the Fed raises rates is housing doesn't slow. It usually goes up. Housing and refi go up because people want to get in before the big jump in rates. And so that's happened to some degree. And I think clearly we run the risk here where if the Fed over tightens, which we don't think they will, we think they'll be more prudent than that. If the Fed over tightens, there is the risk where they could start to ease. Yes. And that could create that opportunity.
One more quick question that I want to, we're at the sort of the 10-minute mark here. I've got a question that says, what effect do you see for the second home vacation home market?
The second home vacation.
Yes.
Look, so what's interesting is we've been locked up for a bunch of, so you can't sit here and look at history. It's no longer a guide. If rates go up, I'm going to do X, Y, and Z. Rates are going up and inflation's up, very high levels, or very high growth rates, but we have discretionary spending power as consumers. Like I said, about $2 trillion in savings. So I want to go on vacation with my family, right? And so, do I want to go to Europe? I'd love to go to Italy. I'd love to go to London. I'd love to go to Spain, but I can't for health reasons, right? Or for, COVID related, or because the cost of international travel is going to be so high, right? Domestic travel, however, if you look at some of the reports and the earnings releases, looking pretty interesting. So I think despite higher gasoline prices, you may see domestic travel and domestic tourism and vacation homes usually struggle when rates go up, no question about it. But you may see people still nibbling at that market because they want to travel.
Because of the post-COVID effect.
Exactly.
By the way, I mean, the airports are showing record numbers, almost back to pre-2020 numbers.
And that's before business travel has really taken off.
It has?
It has not taken off yet.
That's what I was going to say. That's just domestic. That's leisure. And,
leisure. This is starting.
I want to zero in on the Bay Area for a minute. I don't want to be unfair here because your perspective is national, but I know you have a sort of an attachment to the Bay Area. Real estate marketplace again, 1231, 6% rates. What are you thinking about Bay Area real estate?
Well, I mean, look at what California does well in the Bay Area, right? We've got technology, which has been hammered by the stock market, but before year end, I think those multiples have come in so dramatically that I think people will be net buyers again of technology shares. That's number one. Number two, the tech revolution continues. 5G, blockchain, all these things, it is continuing unabated. And so I think that and that's in spite of rates, because people realize rates be damned. I need this stuff to be competitive, right? Food, wine is a little different, more speculative, but look at the food, the agricultural industry, that is absolutely booming, and exports in that sector are one area that should help lift GDP in the second quarter and beyond. In the 2000s, 2005 through 7, I created a term called agflation, agricultural inflation. It is back, and it is back with a vengeance. And if you look at what's going on in Europe, food supply chains, food deserts in cities, phosphates, fertilizers, there's expected to be a worldwide shortage and massive famine in emerging markets like the Middle East and Africa. And so therefore, food exporters should do very, very well.
I.e. California.
I.e. California, exactly. So technology, thumbs up. Food exports, thumbs up. You know, the spirits business, it's more of an upper end business anyway. So it's not quite as cyclical as others are, like clothing. But yeah, I think that should do well. But I don't think you'll see the explosive growth you'll see in those other two.
And this issue of net outward migration to Texas, Nashville, et cetera, do you see that is that just a blip, or should we be concerned?
We should be concerned. Whether you live in New York or California, any of these high rate states, the other states are aggressively pitching to companies and to individuals. And look, we lost, New Jersey lost Appaloosa Capital about 5 years ago. That was 12% of revenue. New York lost ARK Investment to Florida. That was a chunk of revenue as well. And you're going to continue to see that outpouring because people love the social policies, but they don't want to pay for it.
But you're still saying, again, that the real estate market is somewhat immune to that loss because of the shortage of inventories, the geographical makeup of the region, the fact that the tech people want to be there.
Exactly. And I think, look, the lower end jobs, like you'll see a lot of centers, supply centers, data centers, things like that. You don't need to have those in high rent districts. Right. But for the most part, a lot of the upper end, you look at Wall Street, Wall Street's not going to move to Jacksonville. I mean, that's just not happening, right? New York is still the epicenter of that. Silicon Valley is still the epicenter of technology with Silicon Alley. And those two aren't moving. But those back office facilities, yeah, they're going to go to Delaware. They're going to go to Tennessee and North Carolina and Florida, no question. On the margin, that affects that high-end home, but the real high-end homes, those continue to be pushed by the executives and those who are driving the innovation.
All right, we're approaching the 30-minute mark here. Two final questions, Jose, if I can. I know people are going to have a lot of questions of you. I don't want to pester you with that because you're trying to deal with galactic issues. But what I will say to the camera is we have a remarkable head of the mortgage division at HSBC on the West Coast, and that's our good friend Rhonda Munoz, who joins us in sponsoring these programs every month. So for any of us on the call today, if you've got specific questions about mortgage rates, about what we're talking today, email me. You've got my email address, and I'll get you through to Rhonda, and we'll get your questions answered without having to hold Jose to the computer. Two final questions, if I may. Recession coming?
Well,
Deutsche says yes.
Yeah, this year, no. Next year, maybe. 24, possibly. Probability has gone up, but I still don't see it.
How severe, assuming it happens?
If it happens this year, if the Fed raises rates to 3-4%, it'll be severe but quick. So that's the good news. But I don't see them doing that. They're smarter than that, and they delayed because they knew the underpinnings of growth were weak, and they're going to continue to. They would rather see inflation go from 8 to 6 with no recession than have it go from 8 to 2 with a deep recession.
And if it's next year, how severe?
It's hard to tell given what's going on globally, but assuming China is back in operating mode, I don't see a severe recession coming because a lot of financial conditions just aren't flashing warning signals. The canary in the coal mine is still alive and well so far.
Real estate market, residential real estate market. Let's go out 5 years. A good business to remain in?
Absolutely, yeah.
No question.
In the short term, we're going to have this cyclical downtrend, and it could last, 2 or 3 quarters. But I think as we head into next year, hopefully things will have stabilized, and who knows, maybe the Fed is easing. I doubt it, but I think the economy stays well and healthy, and this is a market people want to be in financially and physically. So I think real estate demand stays strong. Yeah.
Final question, Jose. We've got a lot of realtors on the call today. What advice would you give to them in terms of how they deal with their clients? A seller who wants to sell, more importantly, a buyer who wants to buy in a marketplace where the prices are going crazy and the interest rates are going up. Give us some sound advice to the realtor in terms of how they deal with that challenge with their clients?
It's a challenging time because it's like trying to sell stocks, right? It's that forward momentum. People want to buy low and sell high. And when prices are up 15, 30%, hard to make a compelling case for that appreciation of value over time, right? But I think, especially in the high end market, I think you'll continue to see buying will slow. There's no question. Rates will affect it, and sentiment will affect it. And as if people lose jobs in the mortgage business, which we're seeing already, I think you'll see that affected as well. But long story short, it's not an appreciation story so much anymore as it is a relocation story. I think that's really the key. And then the key question is there, once you sell, what are you doing? I think you have to put in place that back end plan before you commit to that sale, right? And I think as a broker, I think that's how you can add real value, right?
Strange question, final question. I cut you a check right now for $300,000.
I'm gone.
Made out to Jose Rasco. I tell you to go invest that for short-term gain. Short-term to me being 3 to 5 years. What would you do with that 300K?
Wow. All right, forget the number. I'm a big believer in technology. I'm a big believer in real assets, and I'm a big believer in digital assets. Those are my top 3. So okay. I think the digital markets are about to turn our world upside down. We touched on it on a prior podcast, and I think we need to go into greater detail on it in the future, my friend. And I've attended a couple of conferences, and it is earth-shattering what's going on in those markets. And I think so technology, real estate, and digital business.
Jose, it's always an absolute delight to have you join us. We get more done in 30 minutes than we get done in the rest of the day. It's at the 30-minute mark. We are adjourned. I want to thank again Rhonda Munoz at HSBC Bank. I want to thank Jose, as always. He is our go-to sage and wise man who puts us straight. With that, we are adjourned. I remind you again, I will send you out a link, or we will send you out a link this afternoon or tomorrow morning for today's session if you had to come in and out. And Jose, thank you as always. We'll let you get back to the important issue of controlling the money supply.
Thank you.
All right. And with that, we are adjourned, ladies and gentlemen. Thank you for joining us today for this special 30-minute program.
Thank you for your time.